mic test. Hope everything is good. Yeah. Hi. Hi. Very good morning to all, and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. Very good morning. Today will be the Friday, the 10th of October, 2025. So as usual, let's have a quick look at the disclaimer first before we kickstart today's Daily Dose. Right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and it's not investment advice. Past information is not representative of future results. Okay, so as usual, before we jump straight into today's we call it chart of the day, let me share with you guys what has taken shape yesterday in terms of the news flow, economic data release, and as well as any important news flow that has taken shape in early today's Asia session as well, and their impact on those broad-based cross-asset classes in terms of the intraday price movement. So let us kickstart with the overnight US market first. So the overnight US market, starting from the stock market, is more of a profit-taking day yesterday. But what's interesting over here is that during the middle part of the US session at around 1:30 a.m. Singapore time, we start to see a recovery coming into the SPX 500, the Nasdaq 100, and as well as the Dow Jones Industrial Average. So yesterday's kind of a profit-taking day was actually due to the lack of catalyst or positive catalyst that is able to push the stock market up, which i.e. the US stock market. Yesterday, there is actually one particular news flow or event that market participants has a very close eyes watch and ears on. It will be Fed Chair Powell public speech over here in one of his conference. I think it's a university conference or so. But however, during this speech by Fed Chair, he did not offer any guidance on interest rate cuts or I'll put it back, he did not offer any new guidance on the Fed monetary policy. So US Wall Street subdued at open after Powell offers no rate cut or no rate clues over here. That means he did not mention anything about monetary policy stances based on this highly anticipated public speech by him yesterday. So that actually causes the US stock market to be in a profit-taking mode at the first half of the session. So as you know, the main culprit in terms of profit-taking, we start to see a slew of red in the mega cap technology stocks. And what's interesting over here is that NVIDIA continues to hold the fort over here, up by 1.83%, outperforming the Nasdaq 100 and as well outperforming the S&P 500. So because of the positive performance of NVIDIA, the S&P 500 and the Nasdaq 100 managed to bounce off from that relevant support that we highlighted yesterday. So very quickly in my update over here, just a very quick brief update on the S&P 500 levels. So before we go into that, this is the S&P levels over here. So S&P over here, it actually managed to stage a bounce of our intermediate support at 6,715, still holding above the rising 20-day moving average, which was our previous short-term pivotal resistance, short-term pivotal support, pardon me, a bit of swing, still holding above this rising 20-day MA, which confluences with our short-term pivotal support at 6,690 over here. Intermediate resistance got to surpass for today 6,764 before the 6,800 take shape over here, which is our previous bullish bias view for it to actually head up to this 6,800 next, holding above the 6,690 short-term pivotal support level. And what's interesting, the Nasdaq 100, which I highlighted yesterday, managed to bounce off from our intermediate support zone, which is at 25,090, 25,000 figure level over here. So with that, this V-shaped recovery, so this V-shaped recovery most likely has come from the outperformance of yesterday's mega cap, one of the mega cap technology stocks, which is very important in the stock market right now. NVIDIA, why? Because NVIDIA is considered as the poster boy of this ongoing AI optimism fuel rally that is supporting this broad-based US stock market bullish run since 2.5 years plus. Okay, 2.5 years ago. So with that, no change on the Nasdaq 100, given that the structure remains constructive bullish on a short-term basis. So I will tighten my pivotal support to 25,000/24,920 for today on the Nasdaq 100, with the same resistance level to watch out for, 25,370 before 25,590, 25,640 over here as it approaches towards the upper limit of this medium-term ascending channel that has been in play since the 2nd of September 2025 low. So the underperformer continues to be the Dow Jones Industrial Average. Why? Because we have a slew of lackluster performance in the industrials, the banks, as well as some of the healthcare, given that these three particular sectors are much more heavily weighted in the Dow Jones Industrial Average rather than the information technology sector. So if you look at the chart of the Dow Jones Industrial Average, previously we do highlight one of the key pivotal support to look out for will be 46,400. So yesterday there was a slight dip below it before rebounding. So this is considered a bit of excess over here. And where it rebounded off exactly at the retest of this rising 20-day moving average. So I'll have a bit of excess over here in my pivotal support level for the Dow Jones Industrial Average, which is i.e. the US Wall Street 30. So that will be at 46,310. So /400, 310. All right, over here. So intermediate resistance still the same, where the level got rejected earlier on Tuesday, this Tuesday, which is at 46,920. So 46,920 is something like an upside trigger level in order for the bullish force to gain much traction. So like I mentioned, potentially this could be due to some positioning adjustment ahead of next week earnings, Q3 earnings kickstart in the US earnings reporting season, where the financials will kickstart the Q3 earnings season next week, starting from the likes of Citigroup, JP Morgan, as well as JP Morgan. Then you have the Goldman Sachs. All this will start reporting next week and the week after. So and also these financials has a higher weightage inside this US Wall Street 30, especially the Goldman Sachs. So with that, that could be potentially a bit of a positioning adjustment ahead of their key component stocks earnings release starting next week in the Dow Jones Industrial Average, especially given that the Dow Jones Industrial Average is heavily weighted towards the financial sector rather than the information technology sector. All right, so that's for the state of the US stock market. So now moving forward for the state of the FX market. So given that even though Fed chair didn't give any rate clues yesterday in terms of monetary policy guidance in his public speech, but the CME Fed Watch 2 continues to assign a high probability of a so-called a high probability of another rate cut in the upcoming meeting in 29th of October, which is at 95% chance. And going forward over here, if you look at the aggregated tab, market is still assigning also a high chance. Yeah, it came down slightly. Previously last week it's around hovering around the 80%, a higher 80%. Now it slipped down slightly to 78% chance, but still a high chance, I would say, given that it's above 60%. That market participants is looking for the third cut of this year, another one potentially to come in before 2025 ends, which is the last FOMC meeting for this year, which is on the 10th of December 2025, to bring the Fed funds rate lower to 3.5% to 3.75%. And also market is looking for 2 rate cuts to come into next year as well. So net overall, what we could see is that market is still looking for a start of a brand new interest rate cut cycle that potentially could actually in a very long term, medium term to long term basis, that odds will be pretty much these odds that we are seeing right now will pretty much dependent on number one, demand side situation that especially centered on the US labor market, and especially also inflation numbers as well. But given that right now the US government continues to be in a shutdown mode, so those government compiled statistics like the official US CPI data non-farm payroll data will be put on hold until the US government reopens. And right now, it seems to us that both sides of the spectrum, the Republicans and the Democrats, are still in squabbles, playing a ship of brinkmanship to see who is to blame in this ongoing government shutdown that could potentially lead to a fear of permanent job cuts in the US agency, where Trump has previously threatened to actually permanently reduce this government personnel, even though the US government reopens again. So the amount of the kind of brinkmanship is still in play between the Republicans and the Democrats. Both of them do not want to back down, which means, i.e., there is still no visibility that the non-farm payroll data and potentially next week the US CPI data may be released. So now market participants will be pretty much rely on privately organization compile data to have a gauge where is the US economy is heading. So later tonight, there will be one particular key data that market participants will be focusing on that could impact the FX market, uh, as well as the US stock market, or potentially driven by the fact of changes in this potential CME Fed Watch 2 probability. All right, over here, because right now market participants in the Fed Funds futures market are still looking out for the start of a interest rate cut cycle. Okay, now for the FX market, we know the FX market sometimes it doesn't move according to fundamental, it moves according to sentiment as well. So based on yesterday's sentiment view, the dollar continues to remain strong, especially against the yen and also against the euro dollar over here. Or you can see the dollar is up against the euro by 1.28%, up against the yen by 2.35%, based on the 5-day rolling performance as we are speaking right now. So basically, it's more driven by these two countries, the two situation in the yen and the euro. Why? Like I explained earlier, the yen weakness is being caused by the fearfulness of this up and coming new Japanese PM Takashi, which is a protege of the former late Japanese PM Abe, who advocates for a rather dovish BOJ monetary policy. So market participants has assigned this fear that she may put pressure on the Bank of Japan to hold on to their current gradual interest rate hike stances in the Japanese economy. So bear in mind, Japan is different from the rest of the world. Japan now has exited from its ultra easy monetary policy since 2.5 years ago, and now is on the path of normalizing, gradually increase interest rates over here. So right now, the Bank of Japan rate is still rather low compared to the rest of the world at 0.5%, and even there's some fear that the new prime minister might actually force Bank of Japan to actually cut rates, which I found that it doesn't justify based on the current fundamentals that the Japan economy is undergoing right now, given that consumer confidence is still on the rise. Uh, core inflation in Japan has stabilized at above the 2% rate for more than 2 years, and also wages continues to increase as well. And bearing the fact that the trade deal between US and Japan has been cemented by the previous PM, that means, i.e., tariff rates will not rise in the near future. All right, so very hard for Bank of Japan to justify going back down to an ultra easy mode again. But nevertheless, market tends to be very sentiment, so it tends to actually boost up the dollar yen, at least in the short term for a time being. As for the euro dollar, it's more driven by the political turmoil in France, where potentially some opposition party in France may call for a snap election or somehow like that. So that actually causes the euro dollar to come under pressure, or the dollar appreciating against the euro. So with that being said, we also know that positioning of the dollar has been very bearish since the start of this year, and with various short-term key levels that's been taken out on the dollar index, that could potentially force a short squeeze on the dollar. So what do I mean by this? So yesterday, the dollar took out this resistance level previously at 98.95 that I highlighted previously. So this 98.95 was actually the downside trigger level that causes the weakness of the dollar to test the 97.30 during August to mid of September this year. So this black Marubozu candlestick was caused by the weak or lackluster non-farm payroll data for the month of July previously. Then thereafter, after it break down below 98.95, it causes the dollar to actually trade on the weaker side. And yesterday's breakout above 98.95 potentially could cause those guys who are still holding short dollar position to unwind their so-called earlier short dollar position, or even triggered some stop loss level that causes yesterday's squeeze up in the US dollar index. So right now, the next resistance zone to watch out for will be the top of this pin, the top of this inverted V shape or bearish reversal candle on the 31st of July and 1st of August, in line with the key event, that is the release of the rather weak non-farm payroll at that point in time, 100.10 over here, followed by 100.54, all right, which is also this bearish reversal candlestick on the 29th of May. All right, so these are the two key resistance level where the dollar may push up further to this zone here, and from there potentially we may start to see another round of important situation that may take another round of what I call tipping point for the US dollar index to actually see whether the bearish momentum could actually come back into force as well, given the fact that the fundamental side of the story still support for a dollar weakness, all right, rather than the dollar strength. So now with that, this level of the dollar index very quickly of the key resistance is 110, 100.54, confluences with two key support level on the euro dollar and the sterling dollar. So very quickly on the euro dollar, a quick recap, we flipped to a bearish bias on Wednesday, where I share with you a full suite of the intraday technical outlook on all the chart instruments that we cover. So the euro dollar actually tumbled as expected, now approaching the support level that we highlight earlier at 115.30. Then I slash it down to 115.10, which is a Fibo extension level on the downside. So bear in mind, it's now fast approaching this 115.30, 115.10 level. So far there is no bullish divergence yet that's being formed on the RSI. So potentially we may see a bit more of a residual push down today, very close to the 115.30, 115.10. So the 115.30, 115.10 on the euro dollar is potentially in parallel with this key resistance level on the US dollar index, which is 100.10, 100.54 over here. So similarly on the sterling dollar as well. So the sterling dollar also plummeted as expected, heading now towards the 1.3265, 1.3210 level. All right, so this zone over here, 3265, 3210, and also very key to the 200-day moving average as well, is equivalent to that resistance level of that 110, 100.54 on the US dollar index. So bear in mind, do watch a close look on these key support zone on the sterling dollar as well at 1.3265 / 1.3210, as it potentially may do this residual push down today. And if we start to shape any bullish reversal candlestick with bullish divergence on the hourly RSI, this could be a tipping point for the dollar weakness to come back into the FX market, at least in the near term. All right, over here. So one thing to note that over here is, very interestingly, why do I say that the dollar index is reaching a key resistance level where the dollar weakness might come back again? Because one of the particular major FX pair, which is the Aussie dollar, has started to show signs of a recovery. Still recall that previously we were neutral between the Aussie dollar. Over here we were neutral, so the neutrality level broke down and hit our support level, which is the 50-day moving average at 65.45, and stage a bounce over here. All right, over here. So it managed to help at the 50-day moving average, whereas the euro dollar and the sterling dollar hasn't even reintegrate back above their 50-day moving average yet. And also what's interesting over here is that it starts to shape a bullish divergence as well. So what I could see here is a lower low, okay, right? Obviously here's the lower low, but the RSI in parallel with this lower low that's being formed has starts to shape a higher low. So indicating that the bearish momentum in the last 2 to 3 days has starts to get subsided, where potentially we may start to see a bit of minor recovery taking shape on the Aussie dollar. So resistance level to watch out for in today's session, 65.75, above it, potentially retest the 20-day moving average that has kept previous rally on Tuesday during the start of the European session, and on Tuesday at the start of the US session, which is 66.05 level. All right, so above 66.05 immediately exposes the upside trigger level at 66.20/66.30, where we see a slew of fierce, we call it a rejection of the bulls on the 24th of September, 30th of September, and most recently 7th of October. So this is considered as my very key upside trigger level in order for the Aussie dollar to gain further traction as it trade back up towards the upper limit of this expanding range configuration that is still in place since 22nd of April this year. All right, so that's for the Aussie dollar. All right, then very quickly, let me share with you something pertaining to the gold market over here. So for gold market, what we could see is yesterday there's profit taking. So if you look at the gold market yesterday, let me share with the chart of the gold market. All right, so gold market yesterday there was a profit taking coming in, down negative 1.62% over here, down negative 1.62%. So what you could see is that gold over here, it did a very strong bullish acceleration. The trend still remains intact. As you could see, is that the daily chart, this is a daily chart of gold, so it's a very we call it a medium-term trend view from a technical analysis perspective, that the daily RSI continues to remains bullish over here. There's no bearish divergence in the daily RSI, indicating that the medium-term uptrend still remains intact. But however, we know that prices from a technical analysis perspective, they don't go vertical up in one straight line, and they don't go vertical down in the downtrend in one straight line. They actually oscillate. So every now and then there will be a period where we must start to see multi-day mean reversion decline or multi-day mean reversion rebound within a larger picture trend situation. So if you look at the chart of the Bollinger Bandwidth, so Bollinger Bandwidth allow us to measure the volatility of the movement of the trend movement. Okay, put it as the volatility of the trend movement. So what I could see over here is that the trend is still up, but the volatility of this trend movement has rise over here. All right, it has rise. All right, at this point in time. So very clearly, there is a overstretch up movement in the gold price. All right, and based on yesterday's bearish move, potentially we may start to bearish move over here. So yesterday bearish move is the largest single day decline within 2 months for gold, spot gold XAU/USD. So with that, we call it a bearishness with that bearish move taken shape yesterday in spot gold XAU/USD, and the Bollinger Bandwidth that is sloping upwards over here, indicating that we are now experiencing a high volatility movement on the uptrend. That means, i.e., indicating a overstretched uptrend. So from a technical analysis perspective, there is a risk of a more pronounced multi-day rather than intraday mean reversion decline that may take shape in gold XAU/USD. So with that, that will be my chart of the day for today. Given this very interesting technical configuration that is taking shape in gold XAU/USD. So let me share with you the intraday chart for gold. So that will be my chart of the day. So let me expand my screen so that you guys can have a better view of the charts. All right. Okay, so very quickly, let me push on the hourly chart of gold over here. So this is hourly chart of gold. So previously, still recall that yesterday I do have some adjusted level at the 3,966 level for gold. So 3,966 level was my adjusted short-term pivotal support. The support broke initially. Price action managed to bounce off from the support during the start of the Asia session, all the way up to the European session, as it fast approached the next resistance level that I have at 4,084, 4,087. But unfortunately, it didn't hit this resistance level and form a so-called a potential minor double top formation and broke below the neckline of this double top. Okay, this is a minor double top, minor because it's an hourly chart. So what we could see right now over here is potentially is this mean reversion decline scenario to actually revert back towards the lower limit of this medium term ascending channel that has been in place since 22nd of August 2025 low, maximum potentially the rising 20-day moving average at 3,819. So with that, I'll be using yesterday's so-called the neckline of this minor double top formation now turns into a critical intraday pullback resistance for today. All right, so yesterday was a neckline support, now turns into a critical intraday pullback resistance, which is my short-term pivotal resistance for today at 4,012. So I will flip to a bearish bias, but not the start of a short-term downtrend or a medium-term downtrend, more of a minor mean reversion decline scenario to do some retracement after the 3-week plus of bullish acceleration phase that we seen in gold that I shared with you on my daily chart a while ago. Intermediate support level to watch out for today, 3,892 / 3,864. A breakdown below 3,864 will potentially take us now lower towards 3,819. So in fact, once price action coming very close to 3,864 / a bit 3,819 is a zone over here, I'll be on the lookout for a bullish reversal candlestick and also the bullish reversal potential, any bullish reversal divergence on the hourly RSI to flip my owners back to the bullish bias again, given that the daily chart of gold is still indicating that the medium term uptrend is still intact. All right, so only a bullish breakout and an hourly close above 4,012 short-term pivotal resistance that I have for today will invalidate that minor mean reversion decline scenario for gold and flip the honors back to the bulls again to see another bullish impulsive up move sequence taking hold, exposing the next intermediate resistance to come in at 4,084 / 4,087, then followed by 4,130, 4,150 in the coming days ahead. All right, so that's for gold, my chart of the day, at risk of a potential minor mean reversion decline using 4,012 as my short-term pivotal resistance level. All right, so before we go, let's have a quick look at our economic calendar. What are the key data to look out for today? All right, so today will be a rather quiet session during the European session. So for the European session, no key data to take note of. And for those who has interest in the dollar Canada, there will be a tier 1 Canada economic data to chew on. Will be the labor market data, which is the unemployment rate, as well as the full-time employment change for September at 8:30 p.m. Singapore time over here. And at 9:45 p.m. we have another Federal Reserve official speaking, Fed Goolsbee. He will be speaking over here. And more importantly, will be at 10 p.m. where market participants will relay on this tier 1 privately compiled University of Michigan consumer sentiment data that is a preliminary one for the month of October. So market participants is also expecting a lackluster print of 54.2. All right, so any number that is below 54.2 will potentially indicate that consumer sentiment has starts to turn much weaker, which eventually lead to lower consumer spending, and that potentially could allow the Fed to continue its interest rate cuts into October and December, and potentially we also may see a higher odds of interest rate cut coming into 2026. So if that starts to materialize, potentially the US dollar weakness may come into the forefront of the market again, given the fact that the US dollar is coming very close to a key resistance level, and as well as the euro dollar and the sterling dollar is coming very close to a support level, and the Aussie dollar has already reintegrate back above the has kind of tested the 50-day moving average yesterday and staged a bounce. All right, which I shared with you guys earlier on the Aussie dollar. And with a much more dovish Fed coming into the picture, that could also support the positive liquidity premium for the US stock market, because you know that stock market also thrive on higher liquidity. That could continue to see the bullish momentum taking shape in the major benchmark US stock indices. All right, so this is Kelvin here signing off. I wish you all a great and restful weekend, and we shall speak again on next Monday. Thank you.